So my name is Marty Kerman. I'm the leader of Cherry Becker's Tax Credits Incentive and Advisory Tax Credits and Incentives Advisory Practice. Thank you for joining today, and thanks for joining this webinar on the Employee Retention Credit legislation, guidance, and updates. I think we have a great presentation for you today. We will be offering 1 hour of CP, and I'm pleased to introduce my colleague, Carolyn Smith-Driscoll, a director at Cherry Becker's Tax Credits Advisory Practice, known as TCIA. She's going to join me in driving today's session on IRS audit defense techniques related to the employee retention credit. And quite a bit's happened in the last month since we did one of these. So thank you, everybody, for joining today. Wonderful. Yeah, okay, here's another thing. Next month, there's another one on ERC in the context of acquisitions, dispositions, and then mastering preparedness for preparations for ERC for 2024. So we have 2 more ERCs coming up, webinars later this year. There's never one month where we're not talking about the employee retention credit due to the fact that there is so much going on with it. And it does have such high interest when it comes to taxpayers. Let's move to the next one. Okay, so these are our pictures. We talked about ourselves already. I think that's enough. You'll see us live as we go through this stuff. So we're going to talk a bit about a number of things. I'm going to do a little bit of just level setting with respect to how the ERC works at the beginning here. And then we're going to talk a bit about this most recent mid-September update where the IRS decided to place a moratorium on processing any employee retention credit claims. It doesn't mean they're not accepting them. It doesn't mean you still can't file. It just means for a period of time, for at least 3 months, they're going to stop processing. And we'll talk about the reasons why. We'll talk a bit as well. Carolyn and I will talk together about IRS exams and the audit process. And then again, we'll talk about ERC claims overall. So why don't we move to the next one? Great. Polling question number 1. Have you or your company applied for the ERC? Yes, no, not sure if eligible, or holding off because of IRS moratorium. And for those who are holding off due to IRS moratorium, don't hold off too long if you really think you missed it and you may qualify, because the statute of limitations does close for the 2020 credits as of April 15th, 2024. So certainly best to get it prepared and ready to file to the extent you know if you think you may qualify.
And file, because then you'll be in line when the IRS starts processing again.
All right. We'll give it a minute or a short period more to see what the answer comes up to be. But clearly, for those who have already filed for your ERCs and just want CPE, don't forget to answer this question. It does seem like there's a number of people who may be interested in actually pursuing it going forward. So why don't we move to the next slide? And again, if you have questions, please throw them in the chat. We'll do our best to answer them as we go through this. So employee retention credit, kind of a misnomer. You hear it in the commercials. I've heard about this thing since, I would say, mid-2020, at least March of 2020, the employee retention credit. There's actually 4 of them. There was the original employee retention credit that had the time period of March 13th, 2020 through December 31st, 2020. And then later, ultimately, we landed on 3 more through subsequent legislation. The 2020 credit is worth up to $5,000 employee, and the 2021 credits are each worth $7,000 per employee. So you hear that $26,000 employee you may qualify for. That's only if you were to qualify for all 4 of the employee retention credits. Why don't we go to the next slide? Well, really important here on that slide, though, is the 2020s are due April 15th, 2024, and the 2021s are due by April 15th, 2025, in line with the statutory requirements for just payroll tax refunds. So it's in line with the filing of the Form 941 and when an amended Form 941 would have to be filed. There's no separate ERC statutory deadline. It's really just in line with what the normal deadlines are for payroll tax refunds. Okay, sorry, let's go to the next one. 2 ways to qualify. Again, we talked about this all the time, but we'll talk about it again. Keep in mind that the credit is intended to reward companies for keeping people employed during a period of time when the government imposed what we'll call COVID-19 orders upon, and not any one government, federal, state, local, that put some limitation on the activities that companies can perform with respect to limitations of what's known as commerce, travel, or group meetings. Group meetings means how many people you can pretty much keep in a room. And so to the extent those government orders are putting, we'll call it a limitation on one's client base, that's generally measured through a decline in revenues, gross receipts, as it's referred to, which includes sales, dividends, interest, rents, royalties, other income as well. To the extent there is for 2020, a more than 50% decline in the gross receipts in any quarter of 2020 compared to the same quarter of 2019, that's an automatic qualification. And you'll see that that rule continues into 2021, except you only need to show a more than 20% decline. So it's easier to qualify under the gross receipts test. The other way to qualify is to basically document and show that a COVID-19 order limiting commerce, travel, or group meetings caused your business to experience what's known as a partial suspension of operations due to the limitation on commerce, travel, or group meetings that is affecting the company directly, or in the alternative. And the IRS posed this one example that to the extent any supplier of the company had basically had a government order imposed upon it that then through a transitive property caused a partial suspension on the business that we're looking to potentially qualify. Again, this supply chain issue where a supplier has a government order on it, it can't provide supplies to a company that wants to claim the employee retention credit. It's a very common fact pattern that's been exploited, shall we say, by, I would say, many who are known as ERC mills that work with clients to try to get them to file claims based on this theory. This theory is one that really needs to be well documented in order to show who the supplier is, where the supplier is located, what the government order is on the supplier, and how that supply chain disruption is having an effect on a more than nominal portion of the taxpayer's business. Whenever you're identifying a government order having an effect on a company, you need to show that it's having an effect on a more than nominal portion of the company's business, which is generally measured through, we'll call it saying that portion of the business generates at least 10% of the gross receipts of the company, or 10% of the hours associated with the employees of that company are dedicated toward the portion of the business that suffered a suspension. So it can't just be on a very, very small piece of the business. It has to actually show, you actually have to demonstrate, potentially mathematically, that the government order is having a negative effect on a more than nominal portion of the business. In 2021, something else happened as well. The credit was expanded a little bit to include some governmental organizations like public colleges and universities and hospitals as well. So that's a little bit different than it was in 2020. It was expanded out. So again, 2020, 5,000 maximum per employee. 2021, 7,000 maximum per employee, 3 times over. Easier to qualify for under showing a decline, under the test requiring the showing of a decline of gross receipts in that quarter compared to the same quarter in 2019. Or you need to show that there was a government order on the business causing a disruption to a more than nominal piece of the business. Again, in 2020, I think it's potentially easier to show a qualification due to the government order test because the orders were stronger in 2020 than they were in 21. And in 21, for the legit claims, it's probably easier to show a qualification due to a decline in gross receipts because the gross receipts test is fairly easy to pass. You only need to show a more than 20% decline. All right, that's the baseline. So now we're sort of talking about where we are today. And Carolyn, please jump in. I know we've been talking about this quite a bit, but in mid-September, specifically September 14th, the IRS, surprisingly, actually, announced a moratorium on processing new ERC claims. And it says at least until 24. I think the expectation is, the hope and expectation is that in January of 2024, the IRS picks up the processing of employee retention credit claims. This does not mean that the IRS is not accepting claims. You can still file for the employee retention credit. And I would recommend that if you have a claim to file, don't wait until January when you get a note that they're going to start processing again. Honestly, you want to get it in line at the IRS and have it there and have it documented that it was received. What are the reasons for this moratorium? Well, it goes back to the fact that the IRS has constantly been constantly, maybe a bit much, but often, maybe monthly, been putting taxpayers on notice that there are a number of companies, we'll call them unscrupulous providers potentially, but they refer to them as ERC mills, companies that are basically forcing companies or making taxpayers feel pressured into claiming ERCs due to the fact that they tell them that it's incredibly easy to qualify. You should every company qualifies for the maximum amount, and many taxpayers are being led astray. And so I think the intention of the IRS here is to honestly give taxpayers a break, have them consult with their CPA, their regular tax providers, such that they can make sure that they qualify according to the advice of a trusted provider, as opposed to some person or organization potentially that has like the name ERC in its title, or anybody that's really trying to, I would say, like push a hard sell for a company to claim ERCs, especially those that are taking, we'll call it a fee that's a percentage of the benefit. Clearly, in that particular case, the provider, the promoter in that case, has an incentive to maximize the credit claim due to the fact that their fee is in line and commensurate with whatever that credit is.
And Marty,
yeah,
we're still hearing that there's 600,000 claims that have yet to be processed. And based upon what you're saying and what we're hearing, and AICPA, it is a pause for not only CPAs and clients to get their ducks in a row, but also a time for the IRS to put together a new approach to auditing these claims. I know at Cherry Bekaert, when we are calling for other service providers to check in and see the status, there are notes on the claims that appear to indicate that they will be examined going forward. So it's
and I don't know. I don't want to credit the IRS here. I understand where they're coming from, due to the fact that I do understand where they're coming from. At the time this thing was put into place, there were 600,000 unprocessed ERC claims that they hadn't gotten to yet. And that number was growing month by month due to the fact that there's no mechanism currently for an electronic filing of an employee retention credit claim. There's no indication on the claim whether it is due to a decline in gross receipts or due to the government orders, so that the IRS can't segregate out into one of two potential piles, I guess, tranches of claim types, so that they can maybe better understand how they process that. And there's just so many claims coming in from companies that it seems obvious that the company should not qualify, and they're doing it due to the encouragement of a promoter. The IRS is really attempting, I think, two things. One, to put taxpayers on notice, as I said, so they can get better advice, or at least make sure they have good advice from their trusted tax advisor. Two, so that they can take a breath and develop a better mechanism for auditing these claims. At the time this came out, the IRS indicated that it was about a 90-day turnaround time on the processing of an ERC claim on average. They've already said it's going to double to 180. Technically, I don't think 180 days seems all that different from what I was actually seeing out there. So I don't know. I would expect that when we get back to it, I will probably still tell clients that it will be 9 months to a year before they see a refund after they file for the employee retention credit claim, which is terrible in some ways, right? Because the entire purpose of this thing was to help companies that were stressed out due to COVID, that couldn't meet payroll. We're way past that time right now, so maybe it does make a little sense that it can take some time. Obviously, the company has survived to this date, but again, the intention is to get funds to companies when they qualify, and Congress clearly intended for there to be retroactive claims allowed due to the fact that that's how they wrote the law. So we shall see what happens going forward, but again, that's what's going on from a moratorium perspective. It shouldn't scare you away from claiming the credit. It shouldn't scare you away at all from claiming the credit, to the extent your trusted tax advisor and you make the determination together that you do qualify based on the actual facts, based on if you had a government order on you, you suffered a partial suspension that can be measured in some way.
Marty, I was just on a call from another service provider earlier this morning, and what we uncovered is that there's a lot of governmental order claims, but there's no thought out connected argument. It is, you know, we suffered a partial suspension, and we found this was a $7 million claim. We found a list of governmental orders that they said affected the client. However, there was no tethering, right? What are the facts? What are the numbers to the government order? Tell us the story. And I believe that when the IRS starts processing, that's going to be incumbent upon not only taxpayers, but service providers who are handling the audits to make those connections, educate the IRS, tell the full story. So something
there's the law, there's the facts. Yes, the government orders aren't enough. The facts need to line up and show the effect of these government orders on the business, and not just maybe telling the story, but showing it mathematically how there is an effect in a negative way. And again, like oftentimes I can say maybe this particular division makes up more than 10% of the company, and that particular division itself suffered a significant, like, we'll call it partial shutdown due to that division having declines in gross receipts, or that division showing some inability for workers to actually perform their services there. And maybe it's not the whole company, but it's a large portion or a more than nominal portion. You just need to find how the company was affected, mathematically tell the story about how there was a negative effect. And I guess what I'm saying here in converse is, when you have a company that has massively increasing gross receipts, it's very difficult to say that you suffered a partial shutdown. And you're going to have to be very, very confident and clear in telling that story such that the IRS will understand how the business was affected. So I'll just leave it at that. Again, you really need to tell that story well. It's not easy, but it is worth it because it's a very lucrative credit. And again, we can help you understand what the facts are from a legal perspective and apply that law to your particular facts as a business. Okay, so talked a little bit about this, but IRS is going to come out with some more stuff here to help companies understand exactly what they should be doing from an ERC perspective. There's also something else that's interesting too. One thing is, to the extent you filed a claim and you really don't feel like after thinking about it, that maybe you should, the IRS is going to provide the ability for you to pull that claim back, essentially. There'll be a mechanism for that. Additionally, what I've heard discussed and read about as well is, to the extent you as a company were, we'll call it, encouraged to file for an employee retention credit, and were told by a promoter that you did qualify, and you got the funds, and then later it turns out that you do not qualify, and the IRS wants those funds back, there may be some mechanism to actually only pay back what you received less the fee you paid to the promoter. I wouldn't want to be the promoter in that particular case, especially if it's going to be the same person over and over again, to see what the IRS does to that particular promoter. But there may be some relief for taxpayers there. They're trying to come up with something fair for taxpayers that were misled. I think it's interesting. I've never seen anything like that before, but it's clearly taxpayer friendly when it comes to requesting cash back. And because a lot of times these companies, they don't have the money anymore, right? They paid part of it to the promoter, they paid part of it to pay their people or to keep their business running, and they don't seem to have it anymore. So that's what we're going to look for. Also, the IRS has constantly put out, what are the warning signs of aggressive promotion? And they'll probably reiterate that. And they have that in some FAQs as well that they've issued. What they focus on is the following. And Carolyn, correct me if I'm not stating them all, but what we're really focused on is, at least in my mind, if the promoter website says you can qualify in 5 minutes, or it says if there's just a general supply chain disruption, that's enough. Or if without having any documentation of how that affected your business. I would also say, thirdly, just stay away from providers that do this on a contingent basis. I think that's going to be a hot button for the IRS. Again, if anybody has questions, we can certainly walk through it with you. And we do all this on a complimentary basis just to figure out whether you do or do not qualify before we'd ever to go forward. Okay, let's move on. IRS exams. Okay. Carolyn, I don't know if we want to take it here or I can keep going.
I'm sure. I mean, what's changing? We're seeing more and more exams. Again, there's a pause. So, and right now they're just paper pushing, and they're asking questions. But what we are finding, as Marty and I, as a third party provider, is that we have clients that are coming to us that can't answer the initial IDR from the IRS because they don't have built out documentation or the governmental order story, or even sometimes the data behind their qualification and payroll amounts. So how's it changing? We're going to see it more and more and more. Again, they're pressing pause, and I believe that the IRS is going to get a lot more organized in their approach to auditing. But we'll see hopefully in January. Who will be audited? Again, gross receipts, easier, right? It's numerical. Any type of supply chain issues and governmental orders, especially as Marty mentioned, when gross receipts are significantly increasing. Q3 governmental orders for 2021, there were far fewer orders. I think those are going to be some red flags. Not sure how the IRS is going to ascertain who was the provider, but I do believe once they've identified some nefarious actors, they will start auditing the bulk of the claims put forth by those actors.
And let me give a little,
Okay.
a little context as well
Sure.
to all the attendees today. We've done over 1,000, worked with 1,000 clients, many more than that to assess eligibility, but probably worked with over 1,000 clients and helped them file for employee retention credits. To date, I think we have seen specifically 4 IDRs from the IRS. So that gives you a sense of like, it's not that many that they've actually gotten to yet. And I'm actually hopeful that's due to the fact that the companies that we've worked with are not pressing any like buttons that would put the IRS on alert. At the same time, historically, the IRS really has gone through the process of just issuing the check, and then at some point may come back and perform an exam. And I kind of think those exams are starting now, and they will start a little bit more. So again, there's a moratorium on processing new stuff that came in from the 14th. There's no moratorium on auditing stuff that's already been in. So I would imagine between now and January, we're going to get more intelligence and see more from the IRS on the examination side. And we'll have more for you because we do this often. So we're always happy to come back and give you the updates. All right.
Well, and I will say, and we're doing this quite frequently, if you're not sure about your claim, even if you've received the money, reach out to Marty or myself and we can review. I think it would be fantastic to hear, yes, you have a strong claim. And if you don't have a strong claim, we can take a look at it. And as part of the IRS moratorium, hopefully there is a vehicle to refile or claw back and not suffer interest and penalties. So general themes, that's what we've been talking about: government orders, increase in gross receipts, red flags. Marty mentioned ERC, the mills, if they can qualify you in 5 minutes. I keep seeing the same ad that says, not only can they qualify me, but I will get my money in 2 days, which it's pretty tempting. Just kidding. Again, supply chain issues, especially going into Q3. That's going to be something that the IRS is looking at. Expectation. Go ahead.
I'm seeing a question in the chat. Says my company applied for 3 quarters of ERCs back in September 21. They have 1 quarter outstanding as of today. I'm curious if that might be a quarter 3 because the IRS has a longer statute of limitations to examine that as opposed to 1 and 2, and they're more skeptical of quarter 3 2021. Do you have any recommendations on the speed of the process? My number 1 recommendation is just get in touch with the IRS and get a sense of where they are with respect to that. Generally speaking, if quarters 1 and 2 have been issued and 3 hasn't, there may be just a problem with the way the original Form 941 was filed, as opposed to taking much longer, especially if they were all filed near the same time. Alternatively, you can work with us and you can issue us a power of attorney and we can contact the service on your behalf and help to figure out what the story is there. I have one client that's working with the taxpayer advocate just due to the fact that they had some originally processing issues with their 941s, and it's sort of like almost confusing to the service, and it's been a little bit, it's fallen through the cracks a bit. So the taxpayer advocate right now is on the side of the taxpayer helping them, but it still hasn't been fast. These were filed in July of 21, and they don't have any of it yet. And so this is one of the 4. But again, this wasn't really due to anything other than problems with the initial forms 941 and the way they were filed. So reach out to Carolyn and myself, and we're happy to talk to you about how to maybe work with the service or at least find out more intelligence. Cool.
In terms of timing, as we've been talking about, processing is halted. I don't believe that audits have halted. I think they're just getting organized in how they're going to approach audits. We've been talking about penalties and interest. Obviously, no one wants to incur that. A bigger piece of this, and we're hopeful that the IRS has a different approach, is the client may be harmed by the promoter, but is the IRS going to come after the promoter and the client? Or how are they going to make the client whole if they truly were a victim of an aggressive promoter? So we will keep you posted on that.
All right. Next slide, if you can do that, since you're control. Thank you. Best practices, again, we're going to focus on statute limitations, most important thing to keep your eye on the ball right now. April 15th, 2024 for the 2020 credits, April 15th, 2025 for the 2021 credits. I'm hopeful nothing changes with respect to these statutes of limitation. The IRS commissioner has basically stated out loud that he would prefer that it be stopped earlier than those normal statutory dates for payroll tax filings. I don't think that will happen. It would require an act of Congress, and acts of Congress are quite few and far between these days. So we shall see. Proper documentation, what to include. Again, when you're filing, it's just a Form 941. There's nothing to file. But to be ready, what you want to have is number of employees that you had in 2019 on a full-time basis. You want to have your originally filed Forms 941. You want to have the amounts you received for PPP in 20 and or 21, and make sure that there's no double count for basically putting into an employee retention credit a wage paid that was funded by PPP. Generally, that's going to require the work of someone like ourselves or a CPA or someone else to make sure that the credits calculated don't show any kind of double count. That's one of the first questions they're going to ask, to make sure that there was no double dip on that. And then on top of that, be ready for what were your gross receipts in 2019, what were they in 20, and what were they in 21, showing that potential increase or decrease. To the extent you had any acquisitions or dispositions during that time, you want to carve off those dispositions or add in potentially acquisitions. And then, well, beyond that, to the extent you are claiming that a government order caused a partial suspension to your business, what was the order? Provide a link to the order or print out the entire order. Then tell your story. What does your business do? What did this order prevent you from doing? And how long did that, what not only was the order in place, but how long did it cause a partial suspension on your business? Because those two things may not be the same thing. So that's what we do for everybody. And that's what we're ready with. And then to the extent the service has questions, we can pull from that and just answer their specific questions directly. All right. Let's go to the next.
And then statute of limitations, Marty, you mentioned for Q3 2021, the IRS has 5 years to audit versus 3. I also want to restate that if there is any indicia of fraud, there is no statute of limitations. So this can be open for years and years.
Okay.
Want to take this?
Yeah, I mean, risk assessment. I think we've actually covered most of this because I tend to speak a lot. So I jumped ahead mentally on what we're going to talk about here. But again, what to ask from a risk assessment perspective is just, does it feel right? Right? Do you feel like you as a taxpayer suffered a partial suspension? And sometimes you're not going to see your gross receipts decline. Sometimes you could get through the day and make adjustments. But if you actually were limited from providing the services or goods that you normally would be able to provide, that's the baseline question. The reason for that has to be COVID related and COVID specific, and specifically due to a government order. And from a documentation, what to include, well, we are, again, you're not filing it with the claim, but have ready to go what we just talked about previously. And I think later we're going to talk about what the specific questions are from the service that we've seen in the information document requests.
And documentation review, that goes to if they're offering a ERC mill is offering to qualify you in 5 minutes, red flag.
Yeah. Why don't you continue on this one if you want? I think we did it already. We talked about it anyway. We talked, okay, so penalties and interest, maybe there. Again, the IRS proposal withdraw, but one thing to keep in mind as well, this is always talked about as like a free money thing. It really isn't, because even if you receive an employee retention credit, you are required to basically take it into income in the past through the mechanism of reducing your wage deductions by the amount of the credits in 20 and or 21. So when you're thinking about claiming an employee retention credit, you do have to take into account the fact that you will have to file an amended return in 20 and or 21. And then at that time, you're going to have an underpayment of income tax so that you'll be paying interest for that. But your employee retention credit, to the extent you're waiting for it, there will be interest paid by the IRS for that as well. So hopefully those will offset each other a bit. But let's move on to the next polling question, which I'm sure everybody wants to get to so they can get their CPE. Do you think you may be eligible to claim the employee retention credit and have not yet filed for it based on what we said? All right, yes, no, or I don't know. And we'll leave it at that for a moment to allow everyone to fill out and try to get some CPE here.
Marty, have you seen the onslaught of TV and radio and TikTok advertisements slow down since the moratorium?
Well, I'm on TikTok all the time. And no, I haven't seen it on TikTok too much, but I have heard it on podcasts a lot when I'm just like falling asleep. And then I'll hear, you too may qualify for $26,000. And then I'll wake up in a nightmare.
Right.
I'm not sleeping that. I've seen the cast of Modern Family pitching employee retention credits on stuff. I've seen it on, what's it called, Shark Tank or whatever, like where somebody came up with an ERC business as well. So interesting how well known this is. And I wonder if people even think it's related to COVID anymore. It's been so far removed from when it first came out. So now let's slow down a little bit. We talked about this generally, but to the extent the IRS has questions, the next 2 slides that we're going to go through, and again, a lot of this can be takeaway, what have you, but this is a really good thing for everybody here to think about and digest. What do you need to claim the employee retention credit? And by the way, they also look at the other payroll tax credit known as the FFCRA, the Family's First Coronavirus Relief Act, to the extent, we'll call this COVID sick leave pay credit. To look at those 2 together because there's no double count on that as well. But here's what we include or think about having as we make the assessment: the original Form 941 that was filed. Obviously, this is a payroll tax refund. You need to show what the original form was and what the amended Form 941X says. You want to show worksheet 1 from that, used to complete the employer credit. Payroll journal, all that really means is let's get a list of the payroll download from your payroll tax provider that shows payments made by employee by paycheck date. And so we generally get those from our clients from the whatever date beginning March 13th, 2020 through the end of Q3, 2021. We want to understand if there was sick leave pay for which there's a credit, the dates that the employees were paid, sick leave or family leave, and the amounts. In addition to the amount of wages, by the way, that goes into the employee retention credit, also the amount of healthcare costs that were covered by the employee during that time goes into that as well. Another thing to think about as well is for large employers in 2020, meaning if you had more than 100 full-timers on average, which is measured actually in 2019, if you qualify for the employee retention credit, you can only get a credit on wages paid to people who were not working. So basically, you're paying them and not throwing them off on unemployment. It's a true retention credit. So you're going to need to find some documentation for who was paid not to work, why, and make sure that that is according to a methodology that is reasonable for purposes of the IRS to understand. Okay, we want to focus on the fact that, yeah, I'm just reading this again. Okay, obviously the W-2 forms, and most importantly, you want to document how you qualified for the ERC, gross receipts or government orders. And then why don't we go to the next one? And I see a question that came in here. It says, what might an IDR say for a recovery startup business? We didn't talk about this, but I'll talk about it now. There's like another tier or regime of the employee retention credit. So to the extent a company was formed basically like mid 2020 or later, and it doesn't have the history of gross receipts back in 2019, there is a credit in quarters 3 and 4 of 2021 available that maxes out at $50,000 per quarter, called the recovery startup. Essentially, for that purpose, I'll add that in here. What you want to have, a summary of what the gross receipts are for the company in 20 and 21 up to the date of filing, and then you also want to have your payroll tax, your journal, the journal of the amounts paid to each employee in quarter 3 and quarter 4. And then to the extent there were any PPP, which is unlikely, that were still being covered in quarter 3 and 4, you want to make sure there's no double count there too. I think that's really what you're focused on for the recovery startup businesses. Really, there's almost a reward for starting a company during COVID, such that there's an extra employee retention credit in quarter 4, 2021 for those companies that were, we'll call it entrepreneurial and actually creating jobs during that period of time. All right, so back to the standard IDR, you want to get the income tax returns for 20 and 21. The point there is, again, you have to do a reduction of your deductions for wages in the amount of the employee retention credit, the whole list of employees, documentation that your operations were fully or partially suspended due to government orders, right? And so that's both what were the orders and what's your story? How did it affect you? And again, documentation around PPP as well, and that there's no double counts. So I think that's what we're focused on. These can be takeaways for any of the listeners or the attendees today, but that's important. This is the stuff that the IRS is going to ask for. And anybody who doesn't have this in their deliverable from their provider, or at least have it available, or they're not put on notice, that's bad. You're going to want to be on notice that this is required. One thing I want to talk about quickly is I have seen so many poorly documented employee retention credit claims that are from, we'll call it one particular provider, but essentially what they said is due to the existence of CDC or OSHA guidelines, the company qualifies irrespective of the fact that they suffered really no partial suspension, just the fact that these things were out there. And so they'll qualify everybody for every period. If your employee retention credit claim is based on just CDC or OSHA, give us a call. Let's take a look and see if we can find another reason. Some certain states adopted those guidelines for COVID purposes, but it's generally not a COVID specific mandate. And so it's not going to be enough to be treated as a government order specific to COVID, limiting commerce, travel, or group meetings. So keep an eye out. I wouldn't be surprised if somebody on here had that happen to them. All right, let's move on to the next one. All right, fraud in the system. Let's go. Okay, so good. All right, so warning signs. Avoid providers that rely on CDC guidance and OSHA guidelines. All right, good. I'm glad I read these beforehand. Also, again, if your revenues consistently increase into 20 and 21, the IRS is going to question how you had a partial shutdown. I mentioned that earlier. Also, this was the big scam. These providers who would say, hey, taxpayer, the employee retention credit, if you suffered some disruption due to COVID, you qualify. Could you sign this certification for me that you qualify? Oh, thank you. Okay, so you told me you qualify. So now they're out of, legal jeopardy, and then they'll do a full filing for you after poorly explaining the rules to the taxpayer. So again, I would just say this: if you're working with anybody who is not going to sign the Form 941 with you as the preparer, don't work with them. Work with someone who will. Work with someone who feels they have some skin in the game. And actually, it's their reputation is on the line due to the fact that they are working as a tax preparer on your behalf. If you're just working with a consultant who's going to, provide you with a calculation, I don't know. I don't see the benefit in working with somebody like that, especially if they're not going to be the one to file the return and help you discuss anything with the service that may be asked or requested by the IRS. Okay. Dirty dozen. Okay, so every year the IRS comes out with, I'm going back in time a little bit because we talked about September, the moratorium hit. Back in May, the IRS put the employee retention credit as number one on its dirty dozen. Every year it comes out with its top 12, we'll call them tax scams, but perhaps, things that they're going to be heavily auditing, shall we say, or taking a look at. So the warning signs for ERC scams, they indicated is unsolicited calls or advertisements. We've all gotten those calls, probably. We've all seen these advertisements. Statements that ERC eligibility can be determined within minutes. It really can if you have all the data, I guess, and it's a gross receipts claim only. But again, anytime you're really making this assessment, especially under a government order claim or a supply chain disruption claim, you need to understand the business and understand how it was affected and the duration of these orders. There's research that goes into it. Also, if they have we'll just call them large upfront fees, and those fees are calculated, in my opinion, based on a percentage of the refund amount. Because again, the provider is incentivized to provide the taxpayer with a large credit. Telling businesses they have nothing to lose by filing this. You do have something to lose. You could be putting in a fraudulent claim, and that's certainly not great. And again, I really think the warning sign is having any preparer who's not signing the thing along with you. But telling businesses to ignore the advice of their trusted tax professional. That's one thing. The other thing is telling taxpayers to ignore the IRS guidance that's out there. The IRS has provided a good amount of guidance. It did specifically back in 2021. And now there's new FAQs out there as well. I've seen providers say, look, I don't think this IRS guidance is controlling. It's not the statute. Technically true. But I would really focus on what the IRS is going to be looking at here, especially considering the fact that this was drafted in haste to provide basically money to taxpayers. But the IRS, I think they've actually done an admirable job of addressing so many claims coming in to get money out that quickly, while they're getting an onslaught of fraudulent claims at the same time, while there's no mechanism for electronic filing. I mean, if you consider those three things together, it's quite a feat that they've gotten through what they have so far. And I'm surprised they didn't do the moratorium earlier, honestly, or come up with some better systems earlier. I guess they really should have, honestly, so that's to their detriment. But again, I think after this moratorium ends, I'm not too worried about the clients we work with because we followed all of this guidance the entire time anyway. But I have seen so many companies be led astray by promoters. Carolyn, anything else, or shall we move on? Your call.
Move on.
All right. Everybody wants to move on from me talking. All right. Polling question number 3. Which of these may be a warning sign for risk in filing employee retention credit claims? Only pick one, or a single choice. All right. A fee based on the percentage of the credit claim file. 2, total reliance on employer to determine if qualified for ERC. 3, 2-minute online application process. 4, OSHA guidance is a government mandate. And 5, any of the above. I mean, honestly, if you don't get this one right, I'll know you guys haven't been listening, but that's okay, because it's it's the middle of the day and it's right before 10:15. So also, I do appreciate anybody who's busy with other things from a tax preparation perspective. All right. We'll see what comes in here. But again, I think all of these things look like pretty big warning signs from my perspective if I were looking at this right here. Okay. Okay. House Ways and Means Committee.
More history.
Yeah, more history. Let's stick to this one. I think they're actually the opposite, but yes, July 27th, there was a really good hour and a half, 2 hour. You can see it on YouTube if you really want more after this, to see what the House Ways and Means Committee did from an investigative perspective to invite certain practitioners, representatives from nonprofits, and representatives from PEO. What was what were the kinks in the system? What was the issue that they thought from their perspective might help the IRS and Congress to understand in order to better, I guess, facilitate ERC claims? And I actually think a lot of what they said went into this moratorium. So if you look back, they were talking a lot about not inability to file electronically, which we think actually may be fixed next year for the last year of ERC. There may be some ability to do ERC claims electronically. The backlog of claims was terrible, and it was specifically terrible for the PEOs, because a PEO basically, it has a relationship with the IRS from an employment tax perspective, and it has to do the filing on behalf of a number of taxpayers on its own on its form. And the backlog for PEOs is quite substantial. And I know many companies are very frustrated with their PEOs due to the fact that the IRS is not quickly analyzing these employee retention credits. And there's nothing the PEOs can do, and there's nothing the taxpayer can do. So it's unfortunately, it's somewhat misplaced anger at the PEOs from the taxpayers due to the fact that I think the PEOs are doing their best to get the IRS to respond and get these claims refunded quickly. But it's just no one anticipated so many employee retention credit claims coming in. Fraud in the system from the ERC mills, obviously. Again, I think at the time this thing happened, they were talking about, they were down to about 400,000 unprocessed claims. By September, they were back up to 600,000, and they were just piling in due to all of the advertisements that were out there. And it was pretty interesting. Well, I think one of the members on the House Ways and Means Committee actually received a call during, or at least provided a recording of a call that they had, like a robocall pushing ERC on them as a member of the House when they didn't even own a business. So it's rampant in terms of like how crazy this advertising is. So again, we talked about Dirty Dozen. We talked about the fact that House Ways and Means Committee was out there. And then one thing that I think was on one of these slides before is that the Office of Professional Responsibility actually provided some guidance that from a tax preparer perspective for income tax purposes, income tax preparers need to actually be wary of doing the deduction reduction for a client who has filed for ERC to the extent the income tax preparer does not believe that's a valid ERC. They're really perpetuating the fraud in that particular case. So I would find that difficult to enforce, but technically speaking, income tax preparers need to be at least advised of the validity of an employee retention credit claim in order to make that reduction of deductions in the amount of the ERCs. Additional amounts, something else that came out as well was what is an overpayment of ERC? How will that be treated legally? And back in July 24th, from a regulatory perspective, it's treated as an underpayment of tax. And so the same rules that apply to underpayments of tax will pay to over refunds of ERCs. And so the same rules will apply. We can move to the next. All right, polling question 4. And I'll just say, yeah, would you like to learn more about how we can help moving forward with employee retention credits? Yes, no, or I don't know. I'll take a look at the chat here and see if there's anything else we can talk about that I might have missed. Can you talk about companies, what they should do if they use a commission-based provider? What should they do even if they received a refund, but until they're actually audited, there's no guarantee of funds? Put the money in the bank would be my best best advice. Don't spend the cash. So to the extent anybody had a question or any question around whether or not they qualify, but they've received the money, I guess 2 things: keep the money in the bank, work with a trusted provider to determine whether or not you actually qualify for this. All right. Let's see here. Well, all right, we'll leave it at that. So I think that's about it today. There's some more questions that came through. I will do my best to answer them directly for those who sent them and provide responses in writing. The point here is I've been harping on this from an ERC perspective, an R&D perspective as well. The benefits of working with an accounting firm, I mean, to the extent you can, I don't know why you'd really work with one of the promoters out there. They're more expensive. They're only focused on the one thing. They seem incentivized to basically increase the amount of credit for purposes of them getting a fee. When working with an accounting firm like Cherry Becker, or really any reputable accounting firm, there's deep expertise well beyond just the one thing that they're looking at. You got to see how they're going to affect, it's going to affect other areas of the tax return. We're really focused on quality. We're signing the returns and potentially IRS defense. We're always pretending that the IRS is going to do an examination of this. That's why we're always putting our best foot forward with respect to documentation. We're doing our homework up front. From a fee structure perspective as well, we're generally cheaper. We will scope this on a complimentary basis up front. We don't want to work with anybody that doesn't qualify for this. We certainly don't want to pressure anybody into it. We're not selling the employee retention credit. We're providing a service. To the extent you qualify for it, we want to be able to allow you to get that credit. It's not our credit, it's yours. So I guess we'll leave that at that as well. But again, anybody who has an opportunity to work with either their trusted accountant or a provider, if your trusted accountant is saying no, don't do it. Or at least get a second opinion from another trusted accountant, not from an ERC promoter. Also, we're always looking at other things, R&D tax credits, anything in the Inflation Reduction Act to the extent you're making investments in alternative energy, cost seg studies to the extent you have a new building, a 179D study to the extent you're improving a building by making it more energy efficient and it's a commercial building. We're looking at state credits incentives, new markets credits as well for expansion in low-income communities. This is what we're focused on always. It's not just ERC. ERC is a hobby for now. I mean, it's a really good hobby, but it's one that we didn't ever expect to get into. It has a short life, and it's one that I think we've done a really good professional job working with our clients on, and it's allowed us to meet a number of new clients as well. But it's not going to be what we do going forward, and it shouldn't be the main focus of any company that I think you work with, because you want to be focused on somebody who's focused on your health as a taxpayer and what benefits you the most. So thank you, everybody, for joining. Again, I'm Marty Karaman. That concludes our session. If you have any additional questions regarding today's topic, please reach out to Carolyn or me. We value your feedback, and we ask that you take part in a short survey, which will appear when you leave this session. Again, as I mentioned earlier, we have a couple upcoming sessions with additional ERC updates. One is acquisitions and dispositions on Tuesday, November 7th, and then another one, mastering preparations for the employee retention credit in 2024 on Thursday, December 7th. And that day will live in infamy. So we hope to see you then. Thank you, everybody, for joining. And we appreciate your time.
Thank you, everyone.